All right, guys, it is time for the main event of the afternoon. If you have made it to this point, you have stood the testament of time here on round number 2 of the FXCM Expo. Gentlemen in the back, glad to have you here. Feel free to take a seat because we are talking about divergence trading. Now, what we'll be looking for those of you that have never traded divergence, that is absolutely okay. You're in the right spot because we are going to go step by step on spotting different kinds of divergence. I call this the diligence divergence trader because, guys, we need to be paying extra special attention. Because as we were talking about reversals, hey, this may not be an absolute cue to buy or sell. This may be a big red flag that goes off in our mind to bump stops. Maybe it's going to give us an opposing bias in the market. So there's many different ways that we can trade divergence. If I have done my job at all today, in the next 30 to 45 minutes, you'll understand how to spot the two types of divergence. That's going to be hidden divergence and traditional divergence. Then you'll know how to take full advantage of that using multiple time frames on your charts for your trading opinion. Now, how many of you have already seen the risk disclaimer? All right, great. You get to see it one more time. This is the most recurring chart that you will see. Guys, Forex trading, it can be risky. We can make money and we can lose money. If you are not acquainted with this here on the screen, take a moment to read it. It will be inside of all of our presentations, all the PDFs, and all the material from FXCM. So be sure to take a good look when you have full time to understand and read the risk disclaimer. Now here we go. The basis of the diligence divergence trader. Here we have it in different points. We will be discussing, for those of you that are unfamiliar with the topic, what exactly is divergence. Next, we're going to be talking about how we spot it by using momentum, indicators, pricing factors, and ultimately spotting the two different kinds of divergence. I've alluded to this. This is going to be the grand finale in spotting price turns. That is going to be traditional divergence. As well, the hidden divergence, just like it sounds, it is hiding in plain sight against the trend. We are going to look to take advantage of that price momentum. So here we go. I did a little bit of research, guys. I broke out the dictionary, something that I haven't done since grade school, and found out the definition of divergence. Well, here it is in black and white. To go or extend in two different directions. They are branching out from a different point. Now, I always like to think of a traditional quote by Frost, "Two paths pass, I take the one less trodden." That's divergence, guys. We see two paths going in different directions. That's going to be the basis of everything we look today. Going to be comparing price. We're going to be comparing indicators and seeing which way they're heading. Now, we are going to look at our first point, divergence in trading. We're comparing indicators and price. Again, price, hey, we can all pull up a chart, we can look at the candles and size up which way that trend is going. The key here is going to be the indicators. Everybody's looking for crossovers on overbought and oversold levels. Not exactly what we are looking for today in the traditional sense. So we're going to think outside of the box a little bit. We're going to put up our charts and take a look and see what's missing. See if we can't fill in the holes and come up with that comprehensive trading idea. Now, here we go. We said that traditional divergence is going to signal a change in trend. This is going to be the first major clue where, hey, maybe something's wrong. Red flags, guys. We're talking about divergence and changes in trend. Get in now and take a seat because we are going to move on and talk about momentum. Now, what is momentum? It is simply the velocity that the trade is heading. Now, who would say that gold has a lot of momentum behind it? Absolutely. Undeniable, the strongest trend that we have in the currency market with the Aussie dollar as well, using that correlation. Here we can see these guys on the roller coaster. Gravity has taken full effect. Their momentum is going to continue regardless. Till those brakes are put on, guess what? They're stuck on that ride. Where are they going? Where they end up? Well, that's up to the tracks to determine, and that's what we're going to do with our charts. Those are going to be our tracks today. It's going to lead us to where price wants to go. Of course, it travels to the path of least resistance. It's a favorite cue of mine, and I bring it up time and time again. Price travels where it wants to. I don't have a crystal ball. I don't have tea leaves. I just have price. I'm one man with an indicator and a chart, and everybody has access to that. So looking at that information, we should be able to come to a common conclusion in regards to momentum on our chart and our indicator. Now, here we go. Price momentum. It's the first component of spotting divergence. Now, taking a look at this chart, what do we see here? Who here was talking with me earlier in regards to the FX boot camp? Any boot campers in here? All right. We should notice that, hey, we have a higher high all the way at the top, and we are making lower lows down our graph. Guys, I like to call this walking down the chart. For me, it's the most relaxing point of my day. Everybody says that trading is stressful. Everybody says it's difficult. We just need to breathe and walk down the chart. Pause for a second and just take a stroll. Up in May, hey, we have a high established at 6,700. We can see a lower low created just above the 160 mark. We form a lower high, a lower low down below 159, and then we have a lower high yet again at 164. This is going to be a recurring theme, walking down the chart, spotting those lower lows. It's going to be the first point of establishing that trend. Obviously, we're going to do this by connecting tops. Guys, I do include wicks. Some people just use bodies of candles, but I like to use the extremes of the wicks as well, because guess what? Price did print there. Somebody traded on those wicks. Somebody bought and sold at those levels. I want to include it in my analysis, for better or for worse. I don't care if it's going to be a market gap, a spike, or all this intervention that you hear about these days. Price is price. Somebody traded there. We need to include it in our analysis. And we're going to do that by connecting our tops and bottoms on the chart. Now, guys, just a quick show of hands here. Who is comfortable with finding the trend? And we have a very good return on that. It looks like we have been doing our job on that first tenet. Finding that trend is going to allow us to see that path of least resistance in regards to price. Once we've established that by connecting our highs and lows, guess what? Price is only half the equation. The next half is going to be the oscillators. Now, MACD, moving average convergence divergence. That's a mouthful. How many people are already using this indicator for traditional crossovers? Excellent. Who here is using the indicator for divergence? All right, even less of you. Excellent. This is going to be the indicator of choice for the start of our program using this classic oscillator. Now, many of you are already familiar. That makes my job absolutely easy in regards to talking about the composition of MACD. All it's doing is taking the MACD line, which is a separation of moving averages, and comparing it to the signal line. Now, for today's settings, in regards to those moving averages, we are using the traditional 12-26-9 settings. When you go into Market Scope 2.0, you right-click and add indicators, and you get that parameter screen. These ought to be preset. Nothing else should be toggled. Nothing else should be changed. So keep everything standard, because we are looking for swings in momentum on MACD. Now, we'll talk about sizing up MACD for divergence in just a moment. I want to cover RSI, because this is going to be the fellow partner in crime, two indicators that we are using today, using that indicator on the graph. RSI Wells-Wilder indicator showing relative strength, generally used for overbought and oversold levels. Now again, guys, who is using RSI? Who's using RSI for divergence? All right, about the same percentage. But that's great. You're already comfortable with these different indicators. You're already sizing up momentum, and you might not even know it. So this may come very intuitive, and that excites me to see you're already using both indicators. So we're one step ahead of the curve. Now, if you're unfamiliar with RSI, that's okay. I'm going to pause for here just a few minutes and talk about the basis of the indicator. So in regards to RSI, It's going to be an oscillator moving between a range. The lower bound is going to be 0. The upper bound is going to be 100. Now, an oscillator, that simply just shows us that price is going to be oscillating or moving in between levels of support and resistance. Now, this indicator has those predefined levels for us. The key here is going to be those overbought and oversold levels that we traditionally use, because we can see that indicator is going to continually trade in a range between overbought and oversold. Now, historically, these are going to be places where in other strategies that we would buy or sell. Typically, if we see prices overbought, we want to sell. If prices oversold, dipping below that 30 level, we may contemplate a buy. Well, guys, we're going to throw all that out the window in just a moment. The key here is that we can read the indicator and understand that as price is loading up, as price is going higher, that indicator, just by its sheer calculation, should be moving higher as well. For everybody putting that indicator on the chart, we need that 14-period classic RSI. No tweaking of the indicators here, guys. Nothing tricky. When you add that on market scope, make sure that we put in our 14-period relative strength indicator. All right, next, we have looked at price. We have looked at our indicators. We're stepping towards finding divergence. Last but not least, we need to talk about matching highs and lows. And we've talked about that before with matching wicks with price. We're going to do it here in a second with indicators. First, we're going to go ahead and draw a trend line. That means that we are going to be connecting the tops and bottoms on our chart. Here we can see that we are moving down and making lower lows. It's going to be the euro-dollar daily chart that we are going to use for our traditional divergence. Guess what? We have a downtrend line here in this example. We're going to be sizing up that on our indicator as well. How we judge slope, it's just going to be the trajectory of the line. Now, guys, I haven't used a protractor since geometry. I'm not really going to sit there and measure it on the chart and be like, oh, this is 32 degrees compared to 35 degrees. We just need to have a visual sample. When we look at that chart, just have a relative gauge of where price is going. Here we can see it's right at about 35 degrees. If you would have said 30, you would have said 45, that would have been fine with me. The key here is that it matches up with the indicator and where it's going. So we ought to see, again, the indicator reflecting price itself. Now, do the lines differ? That's what we're looking for. When those lines differ, that means, guys, hey, we have found our first type of divergence. And here we go. Laid out, we have the two traditional types, traditional divergence. We'll have bearish and bullish traditional divergence. Likewise, we are going to have hidden divergence inside of up and down trends as well. Now, this is going to be used to spot reversals. And I say this time and time again because many of us by nature like to pick tops and bottoms. Now, who would agree and say that this is one of the hardest things you can do in trading? I would. Picking tops and bottoms is absolutely a horrifying experience. When we talk about traditional divergence, we're going to draw on the tops and bottoms of these indicators and see how those slopes vary. If they differ, we've spotted divergence. If they're heading in the same way, the indicators are doing what they're supposed to in following price. And the traditional type of divergence, when we see that the indicator is going up in an uptrend, or excuse me, price is going up in an uptrend, but the indicator is sloping down, hey, that's going to be red flag number one. Something's not right here. That means that we may have a potential weakening of that trend. So that's what we're going to talk about. The key here is timeliness, and I cannot reiterate this enough. Just as I spoke with this gentleman earlier in our conversation, just because we see divergence doesn't mean that it's going to happen tonight. It may not happen tomorrow. Traditional divergence is actually going to take a while to play out. It may take a week. It may take a month. Guys, this is just going to be an indicator that we can put in our tool belt and be ready to take advantage of. Pick our trading indicator of our choice, the strategy of our choice, or maybe it's just time to vacate the premises on those trades. But timeliness is going to be a big factor, so we want to make sure that we don't make any rash decisions. Now, the first type of divergence that we're going to talk about, again, this is of the traditional variety, it's going to be the bullish reversal. Now, I caught some flack in naming this slide. Just a quick show of hands. Who knows what I mean by bullish reversal? All right, just about half of you. So I'm going to have to explain myself here and see if I can't save some face with Jeremy Wagner here. The bullish reversal, this is going to indicate a potential reversal of a bull trend. Think of the euro dollar moving up to 148. Think of gold moving up to 119. These are all going to be bull trends. We should be buying. We're looking for buying opportunities as price has that extreme amount of momentum going higher. Well, bullish reversal, just like it sounds, it is going to show us that price is, hey, maybe going to be turning. Again, that red flag that our trend is coming to an end. Here we go. Just as it says on the graph, just as this gentleman asked in the back, we are looking for higher highs on price, and we are looking for lower highs on the oscillator itself. So thank you for that question. Very pertinent, because that is the first cue that we are going to be looking for on our graph. So here we have it. It is going to be the bull reversal. Guess what? This is going to be the euro dollar, guys. This is what we have been speaking about for our presentation, using it as an example. Now, take a look at this chart back in October of 2010. Wow, euro dollar making higher highs, showing us that we are having a significant uptrend in play. May 2011, price still making higher highs. We attack 148 in the market. Everybody is talking, hey, are we going to all-time highs? Are we going to reach 160? Sky's the limit on this uptrend. Well, if we were using divergence, guess what? We would have had that first signal to say, hey, maybe we need to reconsider our trading strategy here and slow our roll a little bit in regards to the graph. When we draw trend lines and we use them in the bottom of an uptrend, it's going to be used as a level of support. For me, I am using it to judge that price momentum. So I'm actually connecting my highs. This is showing me the slope of that uptrend and traditional bullish divergence. That reversal, we want to compare our highs to the highs of our indicator. Now, these charts were actually taken at the same time. They are side by side. I wish I could have had enough space to put the full chart here on the graph and make them clear enough to view. But I assure you that this is going to be the same point in time. That high that we have on the graph, that's October 2010. We can see that MACD has reached a new high. It is reaching, extending higher with that bull trend. It's exactly what we see on price. Guess what? Our trend continues, culminating in May of 2011, making a new high. Guess what? Indicator's not showing that. The indicator is actually making a lower low. Guys, this is the first red flag that we have saying, hey, something's going wrong here. Our indicator should be pushing higher highs as well. Drawing and connecting those lines, we can measure the slope, and they're actually right again at that 45-degree angle, but they're headed in opposite directions. So this is going to be the first type of traditional divergence that we're going to look for. Once we spot this, we can bump our stops, use a different strategy, or really just change gears in regards to this chart and start making lower lows available on the graph. Now, this is very timely. I didn't expect the euro dollar to break out when I put this up on the screen, but, you know, hooray, we saw new lows being created there. It took 1, 2, 3, 4, 5 months for that divergence to play out. We're now reaching 136.50 and change on the graph. But again, in regards to timeliness, guys, keep that in mind that, hey, divergence, it may take a month. It may take 2 months or more. But spotting it is going to allow us to take the time to tweak our strategy to what we're seeing on the chart. Now, I just want to make sure everybody can spot the higher highs on the price action, correct? We would all say that the euro dollar was an uptrend until May 2011, correct? All we're doing is looking for that bullish reversal, and the first indication, it wasn't a crossover. It wasn't the signal line crossing over on our MACD line. It's actually divergence. And if we're patient waiting that to play out, we can really simplify our trading direction in regards to a new trend. The other side, this is going to be the bear reversal. It's absolutely the opposite. We are going to find this in a downtrend. Now, guys, who wants to shout out one of the biggest downtrends in the market? S&P 500, absolutely. That's going to be one. Absolutely. And we'll go ahead and look at some examples in regards to downtrends, but that is a great one. We've seen indices sell off, and this is going to show that, hey, we can use this on not only currency pairs, but CFDs as well. Now, what are we looking for? Exactly the opposite of what we've talked about earlier. If you can spot that bull reversal, you can sure spot that bear reversal. Just do everything backwards. Hey, what's happening? It's going to be a downtrend. We ought to be making lower lows on that graph. When we take our stroll down the chart, we should see by connecting those lines that lower lows are indeed being made. Likewise, hey, looking at our oscillator, we're going to be making higher lows. This is going to indicate that we are having a potential trend reversal. We may be coming to an end and start looking for buy scenarios. Again, we may not want to hop in directly into the market at that point in time, but it's going to give us a signal to say, hey, freeze, something is wrong with the chart. Now, who here is a dollar CAD trader? Me, I am a huge fan of the loonie. Just in case you are trading that, you're not crazy, you're not loony, because we are seeing another strong trend reversing on our graph. And this bear reversal on the dollar CAD, we can see price dipping down. That CAD example really going up with the new high in oil. Guess what? All of that's changed in the last few months. We see that oil and that correlation has been dropping off. One of the ways that we could have spotted that before it happened was using divergence. This is going to be using that traditional bear reversal to our advantage. What do? We connect the lows to find our price momentum. We can see price moving lower at approximately 45-degree angle. This culminates in a new low on the dollar CAD around 86. Since that time, we've seen price pop back up to the close at 99.60 as of the close of yesterday's trading. This was our first chance to be able to spot and say, hey, Walker, red flag, we may have a possible trend reversal. Same rules apply. Let's go ahead and connect our lows on RSI. We can see that they are sloping virtually identical, however, in opposite directions. Price is diverging from the indicator. We get the heads up. We want to be able to pull ourselves off the table. We want to be able, if we are bullish on the market, bullish on the dollar, this is our cue to say, hey, maybe we are looking for price to break out. Now, I'm a technical junkie, guys. I was just looking at that triple top across the top of the screen. We had that at 9,800, and this is actually what we saw break yesterday on Friday. So exciting stuff. If we spot divergence, we can then use those technical breaks. We can go to smaller time frames, but use that analysis to really give us a trading bias. Now, for the sake of making today's presentation nice and tidy, I am giving us two different signals using MACD and RSI on each different type of divergence. Now, these are going to be the major clues that we need to look for. Some of you may already have a preference to use MACD. Some of you may already have a preference to use RSI. My challenge to you is when you go home, set up that template, and when you specifically look for divergence, get out of your comfort range. Try something new, throw RSI on the chart, and see what you find. Who knows, you might just spot the next trend reversal. So here we go, guys. This is the culmination of our test. Spot the divergence. Now, what are we going to see here on the graph? Is it going to be traditional, bullish, or bearish? Bullish. Absolutely. We can see that our indicators are going to be making higher highs on the graph. As well, guess what? Here we have our lower low directly on our spot as well. This is going to give us a heads up that this uptrend is potentially coming to the trend, or coming to an end. So this is something that we want to take full advantage of by connecting those highs that we see here, dating back to, I believe that's the 6th on the chart. Excuse me, I spend too much time in front of charts. My eyesight's failing a little bit, but yes, we see it was on the 7th. We have our indicator here making the higher high. Guess what? Price is making a higher high still. The indicator is going lower. Connecting those highs on the outside of the graph, connecting our highs inside of that information, finding that 80 value, connecting it to the top of 70, this is going to be our first signal for hidden divergence. Or excuse me, traditional divergence. This is how we can use our technical tools. We can use our candlestick analysis. We can use all of those different functions of just drawing trend lines, tops and bottoms. It all comes into play when we spot divergence. It's going to give us a better bias of whether price is going to break higher highs or is there a reversal on the way. And absolutely, guys, this is when we saw in the pound dollar. It is trading much lower at the present from 160 when I took the screenshot here about a month and a half ago. So absolutely, you guys are spot on. You passed the quiz in regards to traditional divergence. Here we go. Just to show the example of where we have it, excuse me, is the pound CAD. We can see again the highs. And just a little preview, here is some hidden divergence that we are going to look for in just a moment. We can see here that we have the indicators making higher highs, price making lower lows inside of an uptrend. So we're going to talk about that next, and we are going to spot that divergence on the graph. So if everybody is A-OK, thumbs up, we are going to move on to our reversals inside of our trend. Now, I have an extra graph here. I know we've covered this in some detail in regards to how we can use these trend trading changes. I'll just reiterate it. I want to make sure that I hit these points home. Guys, I don't mind saying this 2 or 3 different times. This is going to give us a heads up, give us a warning flag, but what do? Hey, we can go ahead and tighten stops. We can go ahead and exit our trending trades, those opportunities that we may have been in for months at a time. Many different varieties of trading strategies that we can use. Now, if you're looking for a trending-based strategy, we have a number of them. Go ahead and go out. Seek out all the information you can inside the expo and learn as much as possible. But if you're trend trading, keep an eye out for that traditional divergence for a possible reversal. So here we go. Here's the chart I was looking for. It is going to be hidden divergence. Guys, this is one of my bread and butter trades. We can use it with an oscillator. It's going to be divergence found inside of a trend. Now, what are we looking for? Higher highs and lows. Same rules apply. It's just going to happen in a different scenario. Really, we're going to confirm price to indicators. We're all pros at this point, so we ought to be able to speed through this and look at a few examples. First off, we have bullish hidden divergence. Guys, this is going to be found in an uptrend, just like it sounds. Price is going to be making higher lows on the graph. So when we take that walk, it should be clear where price is wanting to go. Guess what? Oscillator's not going to give us confirmation here. The oscillator is going to make lower lows on that particular graph. Well, it's going to be established in an uptrend, just like it sounds, but it's going to be a continuation signal. Guys, this isn't going to be a reversal. We shouldn't use it as a reversal. This is going to be like a springboard. We're going to find the divergence. That indicator is just gearing up to burst forward and see a surge in price that we can take advantage of. So here we go, our first example of bullish hidden divergence. Now, first of all, this is going to be inside of an uptrend. We can see that price making higher highs, the indicator making lower lows. This is that springboard effect. We're judging slope. We can see that price on our graph surging forward at about a 45-degree angle higher. Now, the indicator doing exactly the opposite. Here we have our friend MACD, moving average convergence divergence, making lower lows here. And guess what? We have a friendly crossover to give us an entry signal as well. If you're trading those crossovers, you can indeed use them in regards to divergence. These crossovers, especially on smaller term time frames, can become our ally. Because guess what? Surge in an uptrend, price pulls back. Hidden divergence, we can go ahead, use MACD, use that slope to our advantage and see price bounce down and hop up to higher highs. This is exactly what we have done on this chart. The hidden divergence is looking for trend continuations. It's going to be the anti-traditional divergence. It's going to be the little brother strategy of the two. And again, it's looking for those continuations of the trend. We're looking for price to prop up to higher highs. And that's exactly what we're seeing here. The graph moving up at a 45-degree angle, the indicator going down at a 45-degree angle. Again, the best example that I like to use is like a springboard. You're on a diving board going into a pool. Guess what? You jump down to get momentum just to fling yourself higher. or think of a pogo stick, anything that is going to have that bouncing mechanism. This is what we're doing. Price is pulling in, and it is launching forward. It is accelerating hard to the upside, looking for that trend to continue and make higher highs. Now, it wouldn't be fair if we gave all the attention to MACD. Here we go. We need to make sure that we take a look at RSI, and we are going to do it with bearish hidden divergence. Guys, this is again going to be using the other preset that's going to be looking for price to make lower lows. When we walk down that chart from left to right, that graph ought to be giving us a clear down signal. We should have no clue that we should be selling. When do we gear up? Price gives us that red flag. The oscillator itself is making a higher high. We're ready. We're in the kill zone. We are locked and loaded in an established downtrend. We're finding that momentum. Price flowing in the path of resistance, using that as a continuation pattern. And I can't reiterate that enough. That was a great point that you brought up. Guys, if you take away anything in regards to hidden divergence, realize it's going to be a continuation of the trend, looking for price to head in that established direction. So here we go. As promised, we have RSI on our graph, and this was actually a Swiss cross that I had up here on the chart. We all know that the Swiss National Bank has been discussed and beaten to death today. We're going to avoid all of that. We're just going to use it in regards to the trend and look for continuations. Here we go. We can see the dollar Swiss heading lower, making those lower lows as it's done for the past 2 years. I want to zoom in, connect our highs in the downtrend, again, the opposite of traditional divergence. Looking at that slope, we can see that downward trajectory. It's right at about 35 degrees. How does that alternate in regards to our indicator? Guess what? The indicator's making all-time highs. Something's wrong here. Red flags, bells, whistles should be going off. Pricing that momentum and drawing those lines are going to show us that, hey, we've had a pullback in the trend. This is a time that we can go ahead and enter. Now, again, I really like this example because I know many of you, and you've confirmed this today by the question that I asked at the top, are using traditional crossovers on MACD and RSI. Here you have it. If you spot this hidden divergence using RSI, guess what? It's overbought. It's over 70 on the graph. If you were just trading a simple crossover strategy using that hidden divergence, guess what? This is giving you an exceptional entry, looking that indicator to cross below that overbought level, allowing you to get in with that continuation of the trend. Now, this again was taken over a month and a half ago. Since that time, we have seen the dollar Swiss continue to dominate and make lower lows until the last week of trading. So this is going to be bearish hidden divergence using RSI. We are coming up to the trading aspect of hidden divergence. And this is going to talk a little bit about the crossovers that I've pinpointed on our last 2 charts. First, we're going to find divergence. It's going to be those pullbacks in regards to the trend. I'm going to find support and resistance. I've added at the top of the chart a 200 SMA. Who here has heard a lot about the 200 SMA today? Absolutely, with good reason. It is a great form of support and resistance. I put it on all of my charts, regardless of the time frame. It is exceptional in regards for support and resistance. Going to go into detail on that tomorrow for London, New York trading in full detail. But here, I just want to go ahead and show that in the downtrend. If we spot this hidden divergence, if we can see that price is trading underneath our moving average, we can pull it all together. Use these MACD crossovers to go ahead and enter and exit our trades. It's also got a very straightforward risk-reward ratio. Put it upside your support, or excuse me, our resistance line on our chart. Go ahead and look for the graph to make lower lows. So this is very much a trend continuation strategy. We're looking for that price to dive to new depths and continue making lower lows on the graph. So everybody on board in regards to crossovers. This is why I said this may be something that you are doing already and just unintentionally trading divergence. Once we spot it, we can look to improve our chances for success and know when to use these indicators and pull them out of our tool belt. Now, last but not least, we have the pound Swiss. This is going to be another example of just Swiss domination on the graph. Guess what? Here we have several charts on hidden divergence. I like to use the 8-hour. People say, Walker, you trade the 1 minute chart, you trade the 5 minute chart. What about something a little longer term? Guys, if you have a risk tolerance that is a little bit more conservative than my own, no problem. You can see that we've used this on the daily. We've used this on the 8-hour, and some of our examples earlier were on the 15 and 30-minute charts. So we can find this across the board on different time frames, and here we go. We see that we have that hidden divergence on our 8-hour chart offering us two great entry opportunities on our graph. Again, using just that simple strategy, we have that 200 SMA filter. Take those crossovers of our signal line and our MACD line and trade this pair off to new lows. So can everybody spot the divergence here? All right, absolutely. Raise your hand if you can. All right, we're going to run laps here after the presentation just to get everybody's blood flowing. Absolutely. Here we go. We've actually come to the close of our presentation. You have been absolutely wonderful. This has been my pleasure to speak with you here today. I just want to recap. If you get anything out of today, start sizing up those indicators just a little bit differently. Size up the momentum, and don't just use trend lines for price action. Go ahead and size up the momentum of those indicators itself. So make sure that we are sizing up that momentum on price as well as our indicator and find that separation. Once we get to that point, we'll go ahead and look for entries using a variety of signals. Maybe we're using a trend trading strategy and need to bump our stops and apply a trail. Maybe we want to use a short-term strategy for hidden divergence. The sky is the limit, guys. I just want you to make sure that you're looking at those indicators and spotting something called divergence, something that we don't see in our everyday trading. That is the Diligence Divergence Trader for FXCM. I am Walker England. You have been an absolute fantastic crowd. I look forward to working with each and every one of you tomorrow. Come out and see me. I would be happy to answer any further questions you have. Everybody have a great night, and we'll work again soon.